Number one, be profitable with what you got. Do not take on work that's not profitable. And if you have too much operating costs for the margin that you can put your hands on, you got to trim that OpEx until you're profitable with what you got.
Welcome to the Sales Made Simple podcast. This podcast is dedicated to helping overwhelmed outdoor living professionals, landscapers, and hardscapers just like you increase your closing rate to over 75% without doubling your workload so you can build a seven-figure business that doesn't need you. I'm your host, Joshua Gillow. Let's dig in. Hey, everybody. Welcome back to the Sales Made Simple podcast. This week, we have Greg Crabtree back on with us. If you didn't listen to last week's episode, we talk about the state of the home service economy. Greg went into a lot of great details, just dropped nuggets left and right in there about what you should be thinking about right now, where the guys are investing, what's going on, all that kind of stuff. So if you didn't listen to that, go back and take a listen to that. This week, we're going to jump into Greg's thoughts for the next 3 to 6 months on the economy and how it's going to impact us as home service professionals, landscapers, hardscapers, and outdoor living professionals, and exactly what we should be doing. So Greg, welcome back to the show.
Yeah, I appreciate it. All right.
Absolutely. So let's just hop right into it, Greg. So what do you see coming? Get your crystal ball out. You're Mr. Sunshine. So get your crystal ball out and we'll take a look at it and we'll see, what you're seeing. What should we be preparing for as an industry?
Yeah, and so as I said for last week's episode, we really think the economy is kind of like flat to negative 1% GDP. Right now, if looking at our private company data, and so the reason why I say that. So think about it like this. The last numbers I heard was, probably 70%, maybe even more of the U.S. GDP comes from privately held businesses. Well, in the U.S., the government has zero insight of what those businesses are doing. They don't know how much revenue we had. Right now, we're sitting at the 1st of April. They have no clue what we had in revenue last year. Yes, they could look at payroll data because W-2s have been submitted, at this point, but they really don't. Tax data, very few returns have been filed, and taxes are not economic data because they're all on different bases of accounting that's doesn't match up with economic reality. And so the U.S. has a really big challenge of we got a big gaping hole of lack of visibility, and that change has occurred in the last 25 years. In the year 2000, probably a much more substantial part of the economy was publicly held companies that do report activity, that you can monitor. And so our 100 company model, that's 1.3 billion of revenue, all different companies, our industries, all over the U.S. We don't put our international clients in there, and we don't include our big clients. I mean, so I think the biggest client that we have in there is probably 50 million revenue. So we don't want we got one client's got 400 million of revenue, so they would be highly distorted to the model, and so it's been really, really good that it tells us, when revenue goes up, as I talked about last time, there's 3 things that cause revenue to go up. Did you raise your prices first? Did your market grow? Or did you gain market share? And I'm telling you, from touching all of these data points, unless you're in the AI data center industry or supporting it in one way or another, we have a couple of clients that are in those industries. They're doing great. They've got plenty of demand, but the rest of us, not so much. And so, but now we've got companies that are growing, but they're growing from raising prices and market share gains, in that process. And so now, as I've said before, if you're a great operator, you want this environment. This is good because you're going to finally get rewarded for being the best business in your industry. You didn't get rewarded for being the best business in your industry previously because the Yahoo that cut corners and just was living off of excess market growth did a half-ass job and got paid more profit on jobs than you did because you were doing it the right way. Those people get spit out in environments like this. And we're going to see a contraction even in decent, stable demand industries because people were living off of growth demand, not stable demand. And so, like I said, if you like to compete, you're going to love this marketplace, and you will make
Mm,
more profit, and you will gain market share. The market will gravitate to you, even outside of even. Yes, you do want to do marketing efforts, but you will have a magnetism to your company if you're the best performer in this marketplace. The good news is our our home services, remodelers, landscapers, people that are working in those environments, they're seeing stable demand, opportunities to gain market share, and probably in somewhere in the 5 to 10% growth area, because it's the unique time of people have this insatiable desire to fix up the house that they're in, and
mm,
your dollars, your wallet that you need them to spend with you is not being sucked up by them buying a new house.
mm.
And I don't see significant, existing home new sales demand spiking anytime soon. But I mean, interest rates are just, there's just nothing that's going to make those rates come down other than a government loan program. And I don't think Congress has an appetite to approve that. Well, they should, but that's a different discussion. So
Yeah.
at the end of the day, I really think if you are good at being known to the top 40% of the wage earner marketplace, because those are the people that have money and have resources to be able to do the project, get known, be seen, and do those projects. And I would tell you, as we've highlighted before, do not fall in love with your backlog. Keep your team. As we've always said to our contractors, get out of the yard quickly in the morning, play through the end of the whistle at the end of the day, and if you have gaps in the schedule, pull projects forward rather than push projects off. Those are the key ingredients of the top performers, in the marketplace. And as we talked about previously, pricing to market, not pricing to time and materials,
Yeah.
and then
That-
executing, on your performance. But I really think, and here's the other aspect too, you know, the future is cloudy. I don't see the U.S. economy. I don't see the global economy having an uptick anytime soon. I just got back from a 2-week speaking tour in Southeast Asia. They are scared to death.
mm,
Distributors, I talked to distributors, I talked to manufacturers, and I saw their data. And I did some exercises at the end of my talk, to look at data with them, and they're flat, and they're in this slow decline. And what they're looking at is this happens in the new construction world. We're seeing some signs in new construction right now of people bidding. They don't add any profit. They're not even covering total overhead.
hmm.
And that, I mean, and those companies won't be long for this world. And
Yeah.
so I told one of my contractors the other day in their particular specialty, you've got to prepare to live the next 12 to 18 months potentially of making no profit and just holding on. You're well capitalized. You don't have any debt. You can wait out the idiots.
Yeah.
And
Yeah.
and 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 the thing is, idiots in business eventually have their day.
Yeah. Yeah.
It
Exactly.
and the stupidity catches up with you eventually.
Yeah, and I
And
think
and
about like the 2020 with COVID happening and all that, and everybody jumped in their truck and became a contractor because they weren't
Mhm.
working and they saw the opportunity. Everybody was spending
Yeah,
money. They were taking orders, not even having to sell. Like none of those skills had to be developed because it was just so much. It was so plentiful. And
yeah,
now there's still guys that are holding on that started then that are like, oh, now I got to actually run a business. Now I have to learn how to do this. It's not just all easy like it was there
yeah.
for the longest
And
time. And you mentioned,
and and I
yeah,
mentioned this on the
jump in.
last episode. We're seeing this unusual thing that has never happened before, and since I've been tracking data. The cost of being in business, of what we call non-labor operating expenses, so not COGS, not labor, the rest of the cost in business is advancing with no volume changes at roughly about an 8% year-over-year rate.
Hmm.
And that is destroying That's what we used to make profit on when we grew, because that non-labor OpEx wouldn't move, and we increased our margin other than that cost, and we would get this bolus of profit, that would pop in and go
Hmm.
great, and that would help fuel your growth. That's not happening right now. And
Hmm.
this is the only time I've ever had to eat my words of what I previously said. I used to say, don't worry about non-labor OpEx, because if you get gross margin to labor right, everything works. I can't say that anymore, because non-labor OpEx has become the snake with 1,000 heads, and you just got to start chopping off heads,
Yeah.
and get down to only the cost that you. I said this yesterday to somebody. That says it. We got to get back to scrappy.
Hmm. Yeah.
And I really think COVID, kind of took us out of scrappy mode in business, and everything was crazy. Money was flying all over the place, and now I think we got to get back to scrappy.
Yeah.
And I think the businesses that do that, I mean, they're going to take over and grab the dominant market share. Now, here's the long-term downside of that. If we're in a flat marketplace, and once you get the good market share that's there to get, you're going to flatten out, and and you may be at 10 million, 15 million, 5 million, pick whatever, your segment that you're in. Don't be surprised if you hit a point, and this is what I was seeing in these businesses in Southeast Asia. They hit that point. They were above that 25% profit to gross margin that we talk about as the stretch performance, and they're that and several of them told me, well, we could grow, but the next tranche of business, we'd have to cut our prices by 15% to get the
Hmm.
next 10 million of revenue. And I'm telling you, how hard, if you've got 10 million of revenue at good margin and good pricings and good profit, but to get to the next 5 million of revenue, you got to give a 15% discount. How do you build a fence around the 10 million that's a good price, and then go get just the incremental margin off of the next 5 million? That is one of the hardest things to do in business, because the last price becomes a tendency of what you price everything at. And you
Hmm.
eventually have 15 million at that discounted price, and you're making less money dollar wise than you were when you were at 10 million. And we
Wow.
see it all the time.
Yeah.
And it's
Yeah.
like, come on, folks, it ain't about revenue. It's about
Yeah.
profit.
Exactly.
Now more than ever, I really think, yes, rates of profit is an indicator of health, but you've got to be focused on dollars of profit on the bottom line, and make that dollar of profit go up, and get your eyes off of the percentages. Look at the percentages secondarily, look at the dollars primarily. And
So
if you
good.
can do that, I
Yeah.
think you will run a better business.
I love that. Before we started shooting, you were talking about how for the last 20 plus years we've been in nothing but an upward market and how that's shifting. Can you talk a little bit
Mhm.
more about that and what because a lot of us I've been doing this almost 30 years now and it's like we
Yeah.
we we got drunk on that every year expect growth, every year expect growth, every year expect growth and then boom, we hit COVID and like, "Whoa, where's this going? This is wild. We've never
Yeah.
seen this before." And now it's different. So tell me a little bit
It,
about that.
it is different. I mean, and it's all based on population demographics. I mean, the baby boom generation, kind of mostly started going into retirement, right before COVID hit. And yes, there's a bigger total population band of, I forget which, it's not millennials. I think it's Gen Z, but but they're not productive. We have a problem in that generation. We're missing a significant amount of males between the age of 20 and 35 in the workforce. We know they exist from census data, but
Mm,
they're not showing up in work roles. And I think, there are a lot of those. They're not forming families. They're not having kids, and it's the reason why the U.S. birth rate is dipped below 1.6, and you need a 2.1 to be a stable society. We're not
mm,
as bad as China, but we're headed there. And the whole world is headed there. I mean, the only continent that'll be advancing in population in the next 20 years is Africa. and they have the least amount of benefit to the rest of the world. Of they're politically and all kinds of things just a hot mess as a continent.
Mm,
And so it's not like tapping into Philippine labor because I mean our clients who use Philippine labor. I mean we love them. I mean they got a great work ethic. They're
mm,
Western, in their kind of culture. I mean we see tremendous productivity out of the Philippine labor. Not so much from some of the other places, but that's a group that my clients have done really really well with.
mm.
But the rest of the pockets are not like that. And so I just keep reminding people if you have a flat to declining total population and a flat declining total workforce, how do you have a growing economy? Because economics requires two things, supply and demand. Well, technology, AI, will help us get more things done with less labor, but I didn't create any more consumers. So let's do this theoretical exercise for your listeners. If you increase supply without increasing demand, what happens to prices?
They would go down.
They go down. You do not want deflation. It sounds good until you understand what it does, and that's called depression. And these are going to be delicate lines that policymakers that I have no confidence in. So, I mean, like, just name some policymaker in the whole world that you have
Mm,
confidence in. I'd love to hear it because
yeah.
my list is zero, right now. And so now I'm an entrepreneur. I'll figure it out. But there's a lot of people that won't figure it out.
Yeah.
And so this is kind of where we're talking to the best of the best, on this podcast. The best of the best, how do you be prepared for this? Number one, be profitable with what you got. Do not take on work that's not profitable. And if you have too much operating costs for the margin that you can put your hands on, you got to trim that OpEx until you're profitable with what
Mm,
you got. Number two, you got to be fully capitalized, have no zero drawn on a line of credit, have 2 months of operating expenses in cash. That's as if you have no cash. And
mm,
that's the mindset. And you got to get fully capitalized. And if you're there and you're known to be the best operator in the business, you're going to be fine because the demand's not going to go zero. Yeah, I mean, if it does, we got a different set of problems. So,
Have a different
yeah,
podcast on
yeah,
that.
yeah, that's a different podcast. And so, but if I'm a good business, I'm going to embrace this marketplace because I'm going to win. I'm going to shine. Now, the people that are, that your audience is, yes, this is a, there's some element of necessary to what your listeners sell, but most of it's discretionary.
Yep.
But I'm fine with the discretionary offering as long as I'm offering it to it's a highly desired discretionary to the upper end of the consumer market that has
Yep.
money. And
40%.
it's
Yeah.
going to have money for the foreseeable future unless we change society somehow, some way.
Yep.
And so I'm good with that. But if you're trying to sell to the whole economy at retail, I'm worried about your viability. I mean, we're
Yeah.
we're continuing to see street level retail as we know it just disappear, in
Yep.
that process. I mean, they just can't make enough money because the products that they used to rely on that were the easy sales, you can now buy online. And
Mm,
so if you're a fixed location retail, if you're not charging convenience store prices, you're not long for this world. And we're not going to
yeah.
pay convenience store prices. We'll say, okay, I'll do without that and I'll get it delivered, next day or 2 days. And that's changing. We're seeing Domino's is in bankruptcy. TGI Fridays is in bankruptcy. Mid-tier restaurants are really struggling. A
Yeah.
lot of the large franchise offerings or this franchisees are multi-unit franchisees are in bankruptcy, especially if they were doing acquisitions because they're not cash flowing the debt, that they put on to buy up all those stores. And so we're in a settling out period, of all those things, but you're going to get back to known demand and stability. And, I think that's going to stay with us for 2 to 5 years. I mean, I don't know it matters who's in the president's chair. It matters somewhat, because the one thing that the previous administration did that people don't realize, when Biden took office in 21, the Fed had $5 trillion on its balance sheet, and he left office and he had $20 trillion on its balance
Mm,
sheet of debt. And so that's $15 trillion that filtered through the economy primarily between January of 21 and middle of 22. And we can see that spike in our model during that
mm,
18-month window. And it filters through the economy, creates fake demand. And then once it's filtered through the economy, it sits in people's hands that were the winners. And unless they see something of worth to redeploy that money, they're sitting on it waiting.
yeah.
And I mean, just don't see, a lot of, and people are putting in the stock market. And one of the reasons why the stock market will self-correct every 3 to 7 days outside of the Middle East conflict. But once the Middle East conflict settles down, stock market's going to kind of keep doing what it's doing because it's a captive system. You got a finite number of stocks, and you got money flowing in every week from 401k withholdings. Until those two things change, it's going to have that same slope that it's had for the last 10 years.
Mm,
And
yeah.
it's not based on fundamentals of economics. It's it's based on fundamentals of supply and demand, not fundamentals of profit and return on investment. Because the
Yeah.
average PE ratio of the public stock market is between 25 and 30. That is asinine. I mean, it makes if you've got a 30 PE ratio company that pays 100% of its profits in dividends, which it can't do, it's a less than a 2% yield
Hmm.
for profitability to value. What universe does that make sense in?
Yeah.
It
I
doesn't.
mean, I think so much of that, the market side of things and what drives our homeowners is emotion,
Mm.
right? It's like, oh,
It
market's
is.
down or the war, this is going to happen, and they're in a very strong sense of uncertainty right now. It's just all I got to do is turn their TV off and just go back to the fundamentals, but they don't. They see it on social media, they hear it at work, they're everywhere. So even the big people that are spending, they're still like, is this the right time? I think that if demand is squelched a bit because of the world happenings, that eventually it's going to pop back up again. The demand for what we're doing is not going to go away. It's just a matter of if the timing is right.
Well, I mean, this is a slow, it's slow descent. And so the policy, the policymakers could overreact and create
Mhm.
more problems than what they solve, which is highly likely.
Yeah.
But this population decline, China has been in this dramatic bad population. China's below one replacement birth rate.
Hmm.
China, the math is against China. They cannot recover. It's
Hmm.
just a matter of when. And we don't want them to fail too soon because we haven't moved enough stuff out of there that we rely on every day. Good example is China makes almost 100% of the world's dumb chips. So a dumb chip is a single function chip.
Okay.
And it's the reason why you saw a bunch of Ford trucks parked in parking lots that they couldn't sell back during COVID because the supply chain disruption shut down the chip factories that made the dumb chips. And there's a chip in that fob. And if you can't get the chip, the fob doesn't work. And
Hmm.
the brilliant automakers didn't figure out, hey, you might actually need a key sometimes that actually turns. Duh.
That's funny.
Everything doesn't need to be electronic.
Yeah. Yeah. Yeah.
And so those are the kind of things that, like I said, I always say, well, what do I know? I'm just a chicken farmer from Alabama, so, take what I say with a grain of salt. So,
I love it,
like,
Greg. So, what are let's just say three things if we're recapping here, like three things that our listeners should be thinking about as we move from April to August here that we should be focusing on in order to build that best business that is going to not just, well, we're going to say thrive, but at least survive well through this next 6 months.
yeah, before you try to go gain market share, you got to make sure, check in with your team of, we got to be the best of the best. And so is that in the field services, in the back office, in their quoting, pricing,
Mm-hmm.
look at all of those elements and check in with your team and say, okay, are we at the top of our game? And if you can check those things off, says, okay, now what's our market share gain? Because the market's not growing. And so who is our weak competitors, and how do we take advantage of, you know, do we do specific attack, going after them, or hey, we just want to be on the ready when, because here's in the industry that people are going to realize is when you have a contractor that fails on a
Hmm.
project, that is, we talked about emergency work. One of the emergency works that in your industry that we talked about, weather related damage. We talked about utility disruptions and groundwork that's caused by other people. But the other is a contractor that bails on a job,
Hmm.
and you're the one that goes in to pick up the pieces, and resist. I mean, yeah, I mean, you can be kind-hearted all you want, but you got to charge for the immediacy of jumping in, fixing somebody else's mess. And so the homeowner, I mean, don't pick up somebody else's mess if the homeowner can't pay for fixing the mess. I mean, it's like you
Exactly.
you got to let somebody else fix that mess,
Yeah.
or they'll they'll do the project in a way that you wouldn't be proud to have your name associated with it.
That's right.
And
Yeah.
that's kind of the key. But a lot of times it's a good customer that they understand they're going to pay a premium to fix somebody else's mess. And you can jump in and save the day, and don't
Yep.
be shy about what you charge for that in
Yep.
that process.
Yeah, no, I love that. And another thing that comes to mind when it comes to being the best in the industry is you first have to get the sale, right? If you don't know how to
Yeah.
communicate or to demonstrate your value to the market, then you can tell them all day long you're the best. But unless they
Yeah.
feel it and they sense that they're willing to invest in you and your ideas or your relationship with them, then it's a no go from the beginning. That is the key that opens the door.
And then the third pillar to build on is make sure you remain a fully capitalized business. And
Yeah.
if you have to go on a distribution diet, you've got to flip your mindset as the owner of the business, that you don't take money out of the business when you want to take money out of the business. You take money out of the business after it's fully capitalized, no line of credit, and you've got excess cash that the taxes have been set aside on,
Yep.
and you're not reaching into money betting on you're going to create more profit to replenish the coffers.
Yep. Yep.
You
It's being
got to have that.
responsible. Yeah.
Being responsible, you got to
Yeah.
make it first, then spend it, not spend it and
Yeah.
then go make it.
That's right. That's right. That's a huge one, listeners, right there. I mean, to have core capital with 2 months core capital minimum, setting aside all your expenses in an account and have no lines of credit, none of that stuff. And then as an owner, you're like, okay, now I want to take some money from the company. It's good. But if not,
Mm.
you just better have a good savings account from the good times.
Yeah, yeah, absolutely.
That's it. So, Greg, always appreciate you coming on and sharing your insight. What's the best way for people to reach out to you if they're curious about what you're doing or how to get engaged?
Yeah, so just reach out to simplenumberscri.com. That's the website for our practice unit, and there's a contact page. But I've got a speaker website that has the books listed on it, gregcrabtree.net. But they've got the same contact page there that comes to us. So
Mhm.
but we're if you Google Greg Crabtree or Simple Numbers, I'm about the easiest person to find in the world.
Oh, yeah.
So we're pretty, but we got to, it's not just me. I mean, we have a team of consultants that, we can help you see your data in a more effective way. And we are actually getting better at, doing that more faster as well, as we use, some AI tools to
Mhm.
actually speed up the process of doing the analysis. And we believe in good data fast rather than perfect data late. And
There you go.
too many businesses are dealing with trying to be and when they try to get perfect data, is not perfect, is actually not usable. And so we can help people get to that rhythm that you need to know I'm on track. And if you
Yep.
stay on
Yep.
track, you're going to run a great business.
No doubt. No doubt. Well, Greg, I appreciate you and all your wisdom that you share with us. And thank you for that. And hopefully the
Good
listeners
deal.
picked up some gold nuggets. I know I always write things down when we talk and ways to improve. So thank you for that. And listeners, we'll be back with you next week.